Hey there, everyone. Happy Friday, February 21st, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a kind of rainy, classic February here in Redmond, Washington. Appreciate you joining me here for our market recap show every trading day after the close. On Friday, what we like to do is answer some great questions during the week in our mailbag, and had some really great questions to pull from this time around. I can't thank you guys enough for sharing questions during the live broadcast, for adding questions in the comments section of our YouTube page. All of that super helpful and gives us some great questions to address on an afternoon like this. Before we get to some of those questions and answers, we got about six that I grabbed for you. We do have to talk a bit about the market conditions here. Let's just briefly debrief on what happened. I mean, this is very much a distribution day, and you got a couple things going on. I mean, Walmart continuing to come off after dropping yesterday. Thursday was pretty decent down day, and Friday session just pressing on to the downside. I did get a question about Walmart, so I'll save any additional comments for that. And then the University of Michigan sentiment number came out and not great, and as a result, risk assets moved down pretty consistently. A lot of times what's happened when you have a distribution day like that is, sort of like a sell-off in the morning, afternoon comes, and then things start to improve. That is not what we got today. Really pretty much sold off into the close. I mean, right around 2:30, we ended up getting the low for the day, but not a lot of buyers coming in at any point during the trading day. This is pretty much distribution. What's interesting is if you look at financial media, some of the question or some of the headlines that I saw, something about the Dow sells off due to renewed fears of inflation or of economic growth or whatever. What you have to remember is anytime the market moves, if you're a financial reporter, you have to attribute it to something. You have to say you can't just say stocks went down. You have to say stocks went down because, and have some answer, which is why in interviews I'm often asked, why did the market go down today? Why did the market go up today? Sometimes there's a pretty clear cause and effect, right? And I would say the fact that the sentiment number this morning was a lot weaker than expected. The market's pricing in a certain level of confidence by consumers. If the numbers are a lot weaker than that, sort of suggests that there was way too much optimism priced into stocks. Kind of makes sense. You could also argue that a day like today is just the natural sort of counterpoint to the outrageously strong uptrends that we've been experiencing for quite some time, right? And so it just takes one number coming in a little weaker than expected to sort of ignite all those fears that many had in the back of their mind. So number of reasons I would say why stocks sold off today, but certainly not a great way to finish this week. And again, what we've been talking about recently in our own content is just the signs of concern, right? Signs of distribution. I did a show for Stock Charts TV on Tuesday of this week called The 3 Signs of the Bear, which I'd encourage you to check out on the Stock Charts YouTube channel, because we talk about some of the things that we've been talking about on this show for a while that I think are very clear. So I'm not surprised days like this happen. Frankly, I'm surprised when people are surprised by days like today, if that makes sense. The weaker day today pushes the S&P down 1.7%, just barely holding above that 6,000 level. We did eventually hit a low around 60.10 just after 2:30 p.m. Eastern time, but that's down pretty good. The NASDAQ composite, mid caps, small caps, all down a lot more than the S&P 500. Volatility pushing higher, about 2.5 VIX points to the upside. We're still below 20. We're still below kind of that high volatility threshold, but certainly not a great experience. Bonds rallied today, so it was stocks down, bonds up. The dollar slightly higher. Bonds moving higher and rates coming down here. So the 10-year yield moved down to around 4.40, 5-year point right around 4.25. Cryptocurrencies all sold off. So if you're looking for cryptos to be a differentiated risk asset, not happening. I mean, it's almost like a leveraged stock index in some ways, I would say, the way that cryptocurrencies tend to perform, very much tied to other risk assets, I would say. And then commodities generally moved lower. Gold was notably not too far below the zero level, just 0.1% lower. But most of the commodities, including crude oil in particular, went down quite a bit today. Just wanted to highlight a couple other things, then we'll get to the questions. Other things that stand out. And again, my main process here as a strategist is over the weekend when the markets are closed and I have time to kind of take a step back and take a deep breath and look at how the charts have evolved. That's when I like to really do my deep analytical work about the markets. And then I compile all of that into a weekly flight plan that I share with all my premium members. But for now, I'm just kind of giving you an initial assessment. And these are some of the things I'll probably be touching on in a lot more detail in that members only report. But a couple things to think about here is only 2 of the 11 S&P sectors were up and utilities were essentially flat. So besides consumer staples, that was about it. And one other thing that I noticed, besides the fact that some of the FANG sectors were at the bottom of the list, if you look at the leaderboard today for the S&P 500, you have Moderna, which is a healthcare stock. You have West Pharmaceuticals, which is a healthcare name, and the other 8 are all consumer staples. Is that true? Yep, Hershey, and this is one, Kenvue, which you might not be as familiar with, but that is indeed a staple stock. Kraft Heinz, Monster, Brown-Forman, Archer Daniels, Midland, Conagra Food. Yep, they're all consumer staples. So 8 out of 10 of the top S&P names, all being consumer staples, is not a warm and fuzzy, those are great stocks. These are more, wow, those are the kind of stocks you probably own when you're done owning Meta and Walmart and Synchrony Financial, which popped up. I don't know about you, but I got a lot of green bars on the top of my stock charts login early through the course of the day as things I've been, alerts I've been setting, kind of lines in the sand have been triggered. Synchrony Financial is one of those kind of classic, topping patterns that we'd highlighted. It was a bearish momentum divergence, November, December, January, higher highs in price on weaker momentum. I set that alert for us to break below the swing low as the RSI pushes below 40. That's a pretty classic bearish rotation and indicating a rotation from an accumulation phase to more of a distribution phase. Boy, those are the things that are top of my mind. What else would I say? The heat map is very much a bright red color. On a day like today, note all the large names that are down significantly. Sectors like technology, which are almost all down. That's the story today. I would say the second thing, note things in those growthy sectors that were not down, right? And so that's Apple within the technology sector, essentially flat. So kind of in the back of my mind, that's a name that did not sell off as aggressively. Within communication services, it's kind of like the old telecom sector, AT&T, Verizon kind of names that held up. But in most of the growth sectors, it was pretty much a bloodbath here. Noting in healthcare, while there were some names like United Healthcare getting dinged pretty good on negative news flow, but there were some names that were actually up quite a bit within the healthcare sector. A number of different groups represented there. Consumer staples by far the best sector on the heat map, and utilities probably a close second. So again, focusing on a day like today when most stocks were down, when the indexes were down, try to identify things that were actually not down. And that tells you there might be something there. Either that's a place where assets are rotating. There are company specific reasons why they're not as vulnerable as other names, which are just kind of drifting down and being pulled down along with everything else. But those are where there could be some opportunities. And that's how you can often outperform in a weaker tape is gravitate to those areas of the market that are still showing some strength. The S&P, by the way, testing the 50-day moving average going into the close, essentially hit right at the 50-day, which is just above 6,000 and held it. So going into next week, that's the level you watch, 6,100 now being broken today. That was sort of the initial kind of tactical floor. The 50 days kind of it. And we also have now closed that gap from back here. Now, we've been kind of trading around that gap for a while. So I don't know if that's the most important thing ever, but certainly worth noting that we're now at the lower end of this range. Does the 50-day hold going into next week? And on a closing basis, it's held since early January. And so going into next week, that's kind of where you follow it. The long-term signal for me is still 58.50. I think anything above there is still noise more than anything. But I'm definitely noting another new high on weaker momentum, leading to a pretty significant drawdown in the short term. Maybe one or two other observations. Sorry, I guess I have more to talk about, but pretty big day. So I just want to highlight a couple things. This is the ratio of offense versus defense. And if anything looks a little different to you today, that's because it does. This top part, which is the cap-weighted ratio, offense versus defense, consumer discretionary versus consumer staples, things you want versus things you need, that's been trending downwards over the last 4 to 5 weeks. And the reason is because the numerator is very heavily weighted to Amazon, Tesla, Home Depot. Tesla, Amazon, Home Depot, not great charts here so far in 2025, and they've all started to break down quite a bit. And so as a result, the cap-weighted version has looked very vulnerable here for about a month. The equal-weighted version has been holding up okay until today, when you see 8 of the top 10 S&P members were all consumer staple stocks. That's the denominator of this bottom ratio. And so all of a sudden, as of today, it looks like the equal-weighted version actually reflecting some of the weakness that we've seen in the top part of this chart. That's not good. And so going into next week, you'd really want to see an improvement in that ratio. Otherwise, it suggests a big rotation into more defensive areas of the market. One other thing that we've been talking about, one of my classic signs of a major market top, I have a market top checklist, and this is one of the items on the checklist, is an improvement in defensive sectors. Basically, institutions rotate from risk on to risk off. And if you're a money manager and you have to own stocks, you have to be fully invested, you can't just sell stocks and go to cash or go to bonds or something like that, or go to gold. You have to still own stocks. And so you get into the most defensive areas of the market that you can. So you go to utilities, consumer staples, real estate, healthcare, some of the higher yielding, lower volatility areas of the market that will help you sort of ride out a period of market instability. And you can see that all 4 of those sectors that I just mentioned, given today's rally in the relative strength of those sectors, all 4 of those now look like the relative strength is starting to improve going into this weekend. I think that is a key theme to watch in the days and weeks to come. All right. That's it for the fun recap of an exciting day on the in the markets. Let's get to some questions here and get into the weekend. Question number 1: how does Chaikin Money Flow compare to the Money Flow Index? Great question, by the way, and I've mentioned this probably a number of times recently. I'm ever thankful that although I hated the task and I hated him as a result at the time, one of my early mentors, one of my superiors at Bloomberg, who I, early on learned a lot about technical analysis and how to talk about it from Greg at Bloomberg. And he, basically told me, go into Excel and prove out every indicator that we have on the platform. And I did it. It was a painful experience in some ways because there's just a lot of numbers and having to prove things out. But now looking back, I'm really thankful because now I can kind of understand the mechanics of these a lot better because of that. So there are literally hundreds, if not thousands, of technical indicators out there, some way more common than others. You're asking about a couple that are, a little less common, but still pretty interesting. I'll show you the 2 of them. So this is the Chaikin Money Flow, which is called, CMF is the common abbreviation. And then the other one you mentioned was the Money Flow Index. And again, this is stock charts, obviously, that I'm showing this on. Different platforms may or may not have these indicators. They often can give them different names because there's no real consistent, not a lot of these are like trademarked or registered. So it's up to whoever to determine what they want to call them. Chaikin Money Flow, I've seen pretty consistent. Money Flow Index is one that I've seen have different names on different platforms. So, whenever you can, I would just confirm with whatever charting platform you use, make sure you're looking at the right things. These are kind of similar indicators in that they're both based on volume, but some subtle differences. Chaikin Money Flow kind of applies, it's kind of like applying a volume, a stochastics calculation to volume. Both of these are volume based. Chaikin Money Flow uses a stochastics style calculation, which basically says every day, what's the trading range? And then where did we close within the range? And if we close near the upper end of the range, that's bullish. And so that the more of the volume is considered bullish volume. And if we close near the lows of the day, more of that day's volume is considered bearish volume. And it's an improvement on Joe Granville's on balance volume, which just does one comparison every day based on the direction of the close. Chaikin Money Flow a little more sensitive or a little more respective of the actual intraday movements. So it's kind of like applying stochastics to volume. Money Flow Index is kind of like applying RSI to volume. It's a very similar calculation. RSI, what that does, the RSI indicator basically says over a period of time, over a look back period, usually 14 days to start, what's the average up day in terms of close to close movement, right? So when we close higher, how much higher do we tend to go? And so it's the average up day versus the average down day. So over a look back period, what do the up days look like versus what do the down days look like? And it takes that ratio. And that's why it goes from 0 to 100, because it shows you how strong the up days are relative to the down days. Money Flow Index kind of does that same calculation, but based on volume. So it's like the up days volume, the up volume versus the down volume. That's the calculation. And then you smooth it out over time. So both of these are applying different methodologies and other technical indicators, but applying them to a volume reading as a way of giving you a more, I guess, a more effective way of analyzing trends in volume and just trying to learn more about whether volume represents accumulation or distribution, because you have to make a lot of assumptions to sort of figure that out. Having said that, I use Chaikin Money Flow just because it's something I've used more often. I'm more familiar with it. You can see that the general contours of these indicators in many points are very, very similar, but you can see there's some very big differences between the two indicators, and that's just because of how it's calculated. And again, one using intraday ranges, the other using closes to closes, but trying to sort of develop a methodology of understanding trends in volume. I get the argument for both of them. I use Chaikin Money Flow because that's what I've found has been helpful. If you just use Money Flow Index, I don't think I would blame you that much. My suggestion is use one of these because they both do a really good job of helping you understand the trends in volume and when they change. Chaikin Money Flow is the one that I found more valuable to me, but I would say use one of them and use it consistently along with other indicators that are not based on volume. That's kind of the trick. And I should mention, by the way, if you are on stock charts, click the little lines up here and hit search, type in the name of an indicator, and you'll get taken to the what's called the Chart School, which is a free part of the website where they actually give you the formulas. Some of them, they actually have Excel spreadsheets they've done for you, and you can actually download it so you can see what the calculations look like. Next question. Let's see. For NVDA, does the early January breakout in RSI negate the previous bearish divergence or just reset the indicator or something? All right, let's take a look at NVIDIA. I'm going to zoom into the last year. All right, that was a lot of words. Let me just confirm here. So does the early January, and I think I rephrased, your question was pretty busy, and I tried to boil it down to something I thought I could get out of my mouth on the air as I was looking at charts. Yeah, so I think what you're asking about is basically, there's a clear divergence here in October and November. We talked about it on the show, and again, I would stand by the fact that I think that was a pretty important indication, because for me, bearish divergences don't necessarily mean you're going to go straight down afterwards, but it definitely suggests bull market exhaustion, right? It suggests we're near the end, maybe not at the exact end, but we're near the end of the uptrend phase, and that arguably very much played out because that second high, we haven't gotten higher than that. That was around 150. And that's where we pretty much have had a ceiling in NVIDIA for the last 3 months or so. So your question was, when we had this, right? Then we retested the new high, we actually made a new high and the RSI broke out a little bit. Does that negate that? Yeah, I get your question. I often get questions about what negates a divergence. I guess for me, when I see a divergence like this, it doesn't necessarily, I think my next logical thought is not, let me see if the divergence is valid because of, these other things. For me, that says, all right, we're probably near a top, which means I need to look for signs that we're breaking down. So the two things I would look for was, do we hold that second peak? Meaning, does that become resistance? Which in this case, it very much did, confirming the fact that we're not going up anymore. Even if we're not going down, at least we're not going up. So in this case, we were going sideways. And then what would tell me that that was a top? And for me, that means we're breaking down. So I look for a clear resistance level that holds, and I look for a break of support. So I don't know if I would necessarily say that negates or doesn't that divergence. At this point, I don't think the divergence is the story anymore. I think NVIDIA at this point has settled into a range. And then you want to put on like your range hat, if you have one of those, right? Your sort of, sideways trend, your consolidation cap, and just think about, what level of resistance do I think is going to hold? And if it breaks, would tell me something's different and it's bullish. What support level is important to me, and what breakdown would tell me something different? And if you know what happened afterwards, of course, we gapped lower, which I found a very bearish sign. From there, though, we kind of pivoted in February and rotated back higher. Now we're back kind of languishing in no man's land between support and resistance yet again. So for me, once I see the divergence, it's less about confirming a divergence months later. It's more about analyzing what's happened next and thinking about what levels and what signals would help me anticipate that next leg, now that I'm pretty sure the uptrend phase is probably exhausted. Next question. What are your thoughts on Heikin-Ashi charts and do you ever use them? So the second part to your question, I do ever use them. Do I often use them? 100% no. Heikin-Ashi charts are a Japanese form of technical analysis. There are a number of charts that chart types, which you may or may not have heard about. Renko charts. What else are in those? Some of them are actually on stock charts. If you go, so on stock charts, it's called chart type. And if you look at the bottom, yeah, like Kagi charts, 3-line break charts, Heikin-Ashi, these are all Japanese techniques, charting styles. And they're really not, I mean, if you think about like candlesticks and open, high, low, closed bars, kind of the classic bar or candle chart, these are, there are other types of charts like candle volume or equivolume, which Dick Arms had created, candle volume. Which kind of looks at candles, but the width of the candle is based on the volume. So a bigger volume day is a wider candle. Heikin-Ashi charts basically create candle patterns based on different calculations. So it looks like a candle chart, but you can see it's a lot smoother because it has within the calculation, it has some smoothing techniques. So the close, right, which is sort of the one of the ends of the rectangle on each day. On a classic candle chart, the close is the bottom of a solid candle or the top of an open candle, right? That line is the close. But on Heikin-Ashi charts, it's actually the average of that day's open, high, low, and close. The high price, the low price, the open, the close every day are actually calculated by what happened today and yesterday and maybe even the day before. And it uses some different calculations to basically create a smoother series of candles. Advocates for this particular charting platform or charting style love the fact that it smooths out the noise. Candle charts, like bar charts, can be very noisy. You don't have any gaps on Heikin-Ashi charts because the calculations remove the gaps. So it's kind of like a hybrid candle and point and figure, and then it's meant to track a cleaner movement of trends. The kicker is if you use any technical indicators, once you change the open, high, low, close, all the calculations of the indicators are very different. I would argue that's probably a really interesting area for technical analysis to evolve, is different candle and different price styles like this that are harder to calculate by hand, which is why people didn't do it before. But now in the modern age of a lot of computing power, pretty easy to do all sorts of things to smooth out the data. And then indicators can be optimized for this new structure of open, high, low, and close. So not a lot of work that I know has been done in that area, but maybe that's an area where the toolkit could evolve quite a bit. So that's how they work. They are meant to be a candle kind of chart, but they eliminate gaps, they smooth out the price data, and as a result, I have found it's really clear to see when we're in an accumulation phase or a distribution phase, right? Because in an uptrend, all the candles are clear. In a downtrend, pretty much all the candles are solid. And as a result, big reversals kind of really stand out to you. And I like that. And I would say, especially when you have kind of a quick sell-off like we saw with NVIDIA, when those candles start to change, that tells you, all right, we're probably at a swing point. So if I was a swing trader, I'd probably be really excited about using things like Heikin-Ashi candles, which help you identify changes in trends, ideally very quickly and a little earlier than you would with traditional candle charts. That's the best I can do summarizing this entire charting methodology in like 3 minutes. But again, on stock charts, they've got some free resources called Chart School. Go to Chart School, search for Heikin-Ashi, and it's spelled Heikin-Ashi, and you'll get some great articles that explain the methodology. There is a book written on Heikin-Ashi candles, but not that I've read very recently or that I can come up with off the top of my head. All right, that's the first 3 questions. I've got 3 more to answer for you here in a moment, but just want to remind you here going into the weekend, next Wednesday, February 26th, 1 p.m. Eastern, 10 a.m. Pacific, I'll be doing my next free webcast called Finding Value, the Great Rotation of 2025. This is what happens when I create a webcast and give it a title. I feel like the markets start to move in the way that they either do this or they do something so different that by the time the webcast comes, it's no longer relevant. That's happened, but not this one. I feel like since I came up with this title and discussed it with my assistant, we started putting together all the branding stuff to get ready for it. I feel like the rotation has really started to accelerate. We'll talk about growth versus value, small versus large, technology versus other sectors, the improvement in defensive sectors. We'll look at relative rotation graphs and other visualization. Should be a really interesting market-oriented discussion. You can sign up scanning the QR code that you see on your screen, or just go to marketmisbehavior.com/value. I hope you will join me there. Next question. What is the minimum stock price and liquidity that you consider appropriate for swing trading? Yeah, that's a great question. I don't know if I have a hard and fast kind of rule on something like that. I guess my comment would be, it's sort of like the chart shows you when it's not a good thing. And I'm trying to think of one that, of course, I don't know a lot of names that are completely illiquid, but if you bring up like a pink sheet stock, right, something that's traded over the counter, that is illiquid, meaning it doesn't have a lot of volume on an average day. The chart looks kind of spotty, right? It has these weird gaps all the time. The candles look kind of weird. The bars look weird. It looks like there was a data issue when the chart was being created. That is when you're in trouble. And so generally that's why when I'm scanning for ideas, I stick to the S&P 500 or the Russell 1000. The major S&P indexes, the S&P 500, 400, 600, the Russell 2000. When you go outside of those benchmarks, that's when you can get into stocks that are sort of less liquid and have problems. So I would say, using those indexes as filters can be a good, easy workaround as an individual investor, because the index providers do their own due diligence to make sure that they don't want members of their index that are illiquid or the price data is spotty, because then their index is not that helpful. So they pre-screen and find stocks with minimum stock price and liquidity requirements to even be considered for their index. So starting with members of an index is a really good starting point for a lot of people, because it just filters out the names that are not as good. And I will also say, outside the US, particularly when you get to emerging markets or like frontier markets like developing Africa, Southeast Asia, you get into a lot of liquidity issues where they're not as heavily traded. And again, if the chart looks spotty, I would avoid it and look for something else. So would I put a hard and fast thing? You can scan for minimum things. I would say with stock price, generally looking for things trading over $5 a share is good, because below that, institutional investors aren't permitted to own them. And so I like owning things that a bigger institution would be able to own, because at least then that guarantees some level of liquidity at least. Liquidity, you can scan for average daily volume and just think about how many shares you'd normally be picking up. Make sure that there's plenty of volume being traded, that you're not going to have any problems. And again, if you're at a small enough name where those numbers don't look right, I would pick something else. The great thing about being an equity investor is you have a lot of equities to choose from at any point. All right, next question. What are your thoughts on the Dow Industrials and the Dow Transports as well? Well, that question was maybe a little different of an answer before today, I guess, maybe. But let's look at, actually, I don't know if I have Dow theory in this one. I don't think I do. I just have the newer Dow theory. All right, let's go to this chart list called Equity Market Indexes. I'm going to look like this so I can immediately get to, yeah, here we go, Dow theory. So this is classic Dow theory, the Dow Industrials and the Dow Transports. And what's interesting is what I call the newer Dow theory, which looks at an equal weighted S&P and an equal weighted NASDAQ. It's had a non-confirmation, and maybe let's look at that here quickly. That has a non-confirmation, which we've talked about, where the equal weighted NASDAQ has made a new high in February. The equal weighted S&P did not. That is a bearish non-confirmation, which is actually pretty negative for the broad markets. So again, today coming after that just kind of makes sense to me a little bit, I guess, when you're seeing warning signs like that. Classic Dow theory is this, and neither of these have broken out. Both of these made a new high in November or early December and have yet to break out here. So, the Dow is essentially making a huge double top pattern. I think the Dow above 45,000 would be a pretty constructive breakout, but until and unless that happens, that's a concern. Transports have looked downright ugly compared to most other indexes. And if you think about the things that are in transports, it's not all transportation companies, right? I mean, it's a bunch of different things, but airlines, for example, look pretty rough here recently. Trucking companies have pulled back. So things like shipping companies like FedEx, UPS, like all of these have been coming down here. I mean, UPS has been in a downtrend for year plus. So the things that are in the transports have been very underwhelming relative to pretty much anywhere else. So one of the biggest challenges to this market in the last 6 months has been that transports have looked pretty ugly compared to other things. And so classic Dow theory has not been particularly bullish for a while now. So out of the two, the Dow Industrials in a much better position because transports are filled with things that are mostly pretty bad right now. Airlines, trucking, delivery, kind of shipping companies all mixed in together. But I would say the Dow Industrials better, but still not that good because, failing to break out, suggests limited upside until that changes. Last question, then we'll call it a week here for Chart This with Dave Keller. Doesn't the Walmart decline this week seem like a bit of an overreaction? I'm picking up on a subtle cynicism from the phrasing of your question, implying that you do believe it's probably a bit of an overreaction. That's okay. I don't blame you for that. Let's look at a chart of the Walmart and see how things look. So so what happened with Walmart is, right, basically earlier this week, I think this was on Thursday, they basically lowered, it might have been pre-open Thursday or after the close on Wednesday, because I was traveling back from Las Vegas, basically lowered expectations for the year, basically saying the year's probably not going to be as good as you think. And again, that, as we've talked about for a while, is the danger with big box retailers and AI companies and everything else going up, right? The charts in such strong, consistent uptrends are basically telling you that the market, at least in the form of this chart, is pricing in that inflation is not a problem. Because if inflation's a huge problem, I can think of one big box retailer named Walmart and others like Costco and Target and others that's probably going to hurt, right? If inflation is a concern and consumers are less willing to spend money, that hurts companies whose businesses build around consumers confidently spending money as much as possible on things. And so that is a very logical, issue, I think, that we've had. And a bit of a contradiction is the fact that these charts have been so strong for so long, basically telling you Goldilocks scenario, inflation is a non-issue. What the Fed has been doing has worked just fine. And consumers aren't going to change their behavior. Within the last 48 hours, we've had Walmart telling you, what, this year's not going to be as good as we thought. And then consumer confidence this morning tells you, what, consumers are not that optimistic about things than we thought either. So that's two negative headlines this week suggesting, while not directly suggesting that inflation is a bigger issue than we thought, certainly is tangential to that, certainly teases on that being kind of a part of the issue. So again, that has been the risk to this market, is at some point kind of the collective investors wake up and go, uh-oh, what if inflation is kind of an issue? What if, consumers are not that willing to spend money? Then this is going to hurt certain companies. So is Walmart an overreaction? I mean, I wouldn't say so. I would say, is the ridiculous uptrend that we've seen in the last 12 months more of an overreaction? I would say so. I would say that expresses a ton of optimism. I don't know if it has been completely justified. And so we're pulling back a little bit, but we're just touching the 50-day moving average today, for the first time since mid-January, and it's held a bunch of times. This is not that much of this is not an overreaction. Arguably, this is an underreaction if the things that have come out really are going to play out. That Walmart is probably trading way richer than it should, given that we're trying to price in forward-looking expectations. So there is the other side of the coin to, I guess, the way that you phrased your question. And I get it. It seems like a big change. But when a big drop like this has happened after such a long run, this is a stock on an adjusted basis that's gone from 50 to 105 in just over a year. I mean, on a big stock established company like Walmart, I mean, that seems like the more irrational part of this chart, not the last 2 days that have gone down a little bit. There we go. That's my take. Folks, cannot thank you enough. These questions make me think. They help me to come up with interesting examples to share with you. And, hopefully along the way, we can share best practices about technical analysis and behavioral investing and just try to help you make sense of everything going on in the world around you. Again, a pleasure to meet a number of you in Las Vegas for the Money Show. I am working on appearances through the remainder of this year. I won't be able to get to some of the money shows here coming up in Dallas and Miami, unfortunately, but did talk to the Money Show people about doing some events later in the year, and I will hope that to see you at some of those. And I'll also be speaking at some other conferences like CMT Association events and other events around the world, it turns out. So I'll keep you updated, and anywhere that you're at that you can come say hello, I wish you could do so. But for now, I wish you a restful and enjoyable weekend. Please take good care. Have a great one. And remember, it's always a good time to own good charts. Take care, folks. Bye now.